everybody. Morgan Christen, Spinnaker Investment Group. Today I'll be talking about quarter two of 2022 and our thoughts as we go into the third quarter as well as the fourth quarter. Well, it was a tough quarter. The first quarter was obviously a tough one, but the second quarter actually eroded a bit more. As you'll see here on this chart, the S&P off 16, the small caps were down 17, but even international markets and bonds, everything was affected by the second quarter. So a continued bump in inflation, interest rates went up a bit and affected basically all sectors of the markets, even real estate. Now looking at a one-year chart from June of 2021 to June of 2022, you can see here things were going along okay, just bumping along nicely till all of a sudden the inflation hit. Interest rates went up, and that's when it started about the beginning of this year. And you can see the real drop off there as we headed into June. So looking at U.S. stocks, you'll see that value stocks actually perform decently compared to their growth counterparts. Big part of that is interest rates. Interest rates affect growth companies more than they do value companies. So we've seen that in the technology sector. Maybe some of these earnings are further out in the future. So growth had a bigger hit over the long run. And you'll see at the bottom corner of that chart, over the 10 years, value was behind growth almost 10%. So that's a big margin, and that margin's starting to come in. So it's only about 4 percentage points now over the 10 years. So there's definitely a move towards value right now, or at least a move out of growth over this the last 6 months, and even into right now, which is July. We saw that also in the international markets, value performing better than growth. And you look in the emerging markets, not as pronounced. You can see it. Not that much of a difference. Less of those growth stocks, less of the technology stocks, less of those stocks out there. So not as much of a difference, but still an outperformance in value over growth in just about every market out there. And if you want to look at the countries, so we just looked at international as well as emerging. So the only country that actually had a positive return for the last quarter, the second quarter, was China, one of the emerging markets. So everything else, every other country was down, some of them pretty significantly, as you'll see on the far right there, that's Peru. Real estate investment trusts. So these are apartment real estate investment trusts. They have malls, they have commercial buildings, a lot of different things. Well, when interest rates go up, these type of investments tend to be in competition with bonds. So if I can buy a 10-year bond or paying 3%, or even right now, maybe even a 1-year bond, I'm talking about a treasury bond paying 1%, that starts to become competition with real estate investment trusts. A lot of times people think, well, real estate is a good inflation hedge, and it is. However, when you look at the traded markets in real estate investment trusts, sometimes they are affected by interest rates. So the higher those rates go up, sometimes you can feel the pain. And you'll look here in the chart, international markets have not been too kind to real estate investment trusts. The global REITs, 3 years are negative and just about to go negative for 5 years. So U.S. are holding up, and we still have allocations in them. We think that's still a good part of an overall allocation to a portfolio, not a large percentage, but we we've always liked the U.S. over the international markets in that space. Commodities, so for the last quarter, second quarter, anything in the oil world did well. So you'll see at the top, oil did well, and on the way down, anything wheat, cotton, one of the biggest, and which we'll show a slide in a minute, is copper, off 22%. So why does copper matter? Well, copper goes into everything that we think of when we're a growing economy. When copper slows down, that generally means that the economies are starting to slow. And you'll see here that over the long haul, it's been a negative investment over the 10-year period to own this basket of commodities. So speaking of copper, here's the chart here. This is just from the second quarter. You can see how copper dropped, lumber dropped, cotton, corn, wheat. So really the only thing that is holding up is oil in that space. So could be seen as not inflationary, because if these start coming down, that would say that inflation is starting to peak or it's taming. Also that the economy may be slowing, but certainly something to watch and something we're paying attention to. Bonds, this is a view of interest rates, and this is basically the whole yield curve from 0 out to 30 years. And you can see on 6/30/22, we were pretty flat. We ended the quarter basically flat, 3% across the board, except for very, very short term, and those are starting to inch up. But a pretty big shift from 331. So that's why bond values went down. Interest rates went up. They shifted up. Bond values go down. There's an inverse relationship there. But if you go back 1 year, you look at a pretty dramatic move from 6/30 of 21 to the last quarter, 6/30/22. And a big part of that is the short end of the curve. So 0 to basically 1 year, 2 years, and that's the Fed. So when you hear the Fed is hiking rates, which tomorrow they're looking to do again another 75 basis points, that's where the Fed comes in. Those are the short-term rates, and that's why we see a pretty dramatic shift on the short end of that curve. But also they all came up across the whole yield curve. So let's talk a bit about the economy. Well, we talk about Hyman Minsky, and he had a financial instability hypothesis. Basically, stability creates instability. So what did we have over the last quite a few years, 5+ years? We had 0 interest rates, so things were stable, things look great. And so now what happens with that? Well, people start investing in things they may not, they should not, I should say. Then also we create situations where inflation. So if people are bidding things up, prices of houses, prices of cars, everything starts moving up in value. And so we see that in a lot of different areas. But the manufacturing sector, that first chart on the left side, that started moving up. Right below that, rents started going up. So 0% interest rates create some inflation over time. And then to the right there, wages. Now wages are finally moving up after a long period of flat wage growth. So inflation has now arrived after this stable period of 0% interest rates. So the Fed's out there and they're bumping rates here. So that dark blue squiggly line is where the Fed is, or that's a 10-year yield, but that light blue below is where the Fed has been bumping rates. So you can see that there's a little bit of a disconnect between where the 10-year is at and where the Fed is. So the Fed will be bumping rates again, but the market has already adjusted to what is perceived as these higher rates, and you'll see that in those orange dots. So that's what the Fed puts a dot plot there. So you look at that, that's where they believe they will go. And so by the end of 2023, by the end of 2023, they'll be close to 3.5 or something like that. But you'll also see maybe a move down at some point, which we'll talk about in a minute. But this is the Fed. The Fed is now fighting that inflation that we saw because of those 0% interest rates, and that's them bumping up interest rates. So the effect of the interest rates going up, well, you can see here that home sales are down, upper left, because on the bottom right there, mortgage rates are up. So mortgage rates are up, applications are down, but as we'll see to the bottom left there, prices really haven't come down yet. I think you'll see in your local town there's some price concessions coming, but I think it was this final push where people just put an extra couple, 10, 20, 30, $100,000, $200,000 on the value of their property. So we're seeing some of that come back down. So we're seeing some adjustments, but overall, housing prices haven't come down dramatically yet. Although it's slowing down, there's more houses on the market now, supply is going up, and the mortgage rate is definitely affecting that. So part of that 0% interest rate, now all of a sudden the Fed starts raising rates, things start changing, is the probability of recession has gone up. You can see that big spike that was in 2020 where we had that during the pandemic. And so the probability is bumping up a bit. And tough thing to do though, usually when you go into a recession, we have job issues. So we are hearing some companies that are no longer hiring or they're laying off. But right now, as we speak, there's 2 jobs for every 1 person looking. So it's tough to have a recession when you have so many jobs out there. So it's an interesting thing there because usually 2 quarters of negative GDP growth says there's a recession, and that could happen. However, there's other metrics that they look at, jobs being one of them, and most recessions have pretty big layoffs, and that's just not the situation right now. So I was alluding to this earlier, but this is where the Fed is going. So this is the Fed dot plot. And you can see that they're looking to tap out at about 3.5, 3.75 by the end of this year. And potentially, and this is where the numbers they're putting out there, those dots are all the different Fed governors kind of guessing where rates will be. And you can see there might be rates coming down in the future in 2023. So it's a couple different things that we're looking at. Maybe they do believe they'll push us into some sort of a recession, and so they'll have to give back some of that, pull back some of those increases. And so that's an interesting look there, because now people are concerned, should I buy a house? Well, maybe if you're getting a discount now, maybe if the house is 10% off, maybe that mortgage will be lower in the future. So it could be stimulative, and it could help the market as we go forward, at least the housing market. It could also start helping the equity market. I think that we wouldn't be jumping into growth stocks, but if you start seeing rates come back down, that might help some of those sectors. So we'll be watching that, but this is where the Fed currently believes rates will be going. So let's talk about the consumer and the investor. Well, consumer sentiment is the worst it's been since the 50s. So if you look back to 1950, we've had a lot of things that have happened that are far worse than what's going on today. So the consumer is freaked out a bit, and most of it is because of inflation. So we just haven't seen readings like this. So it's a very freaked out consumer with these sentiment numbers, very, very low. But they're still out there spending. The savings rates has come down, but they're still saving. Their credit card balances are going up a bit. Nothing too dramatic, but we are starting to see a bump up there. So even though they're freaked out a bit, they are spending. But the good news is that debt hasn't increased for the consumer. So you look at household debt here as a percentage of GDP, that dark line, it's still continuing to move down. So the consumer is in pretty good shape. Their debt levels have dropped. And you look at not only households, but also at corporate balance sheets. There's a tremendous amount. This is liquid financial assets, so cash, money market accounts. There's a tremendous amount of cash sitting there in both the corporate balance sheets as well as the household. So they are sitting on some cash. And they're also sitting on a tremendous amount of home equity. You can see in the last recession, I won't count the 2020, but back 07, 09, home equity, because that was a housing recession, and so the consumer's feeling still, which is odd, they should feel pretty good because they are sitting on a tremendous amount of equity in their home. And most Americans, their biggest asset is their home, so usually they feel pretty good when they have that kind of cash in their house. And that recession I talked about, 07, 09, that's that bottom kind of gold line below 100. That recession took a long time to reset net worth. That took a long time for that recovery to come back, because that was a housing recession. Housing being that big asset for most people, it takes a long time. That really hurts the consumer over the long run. Prior recessions, the stock market bubbles, various things like that, the tech bubble, COVID, different things like that, those were more of equities pulled back a bit. Real estate did not. So most people on the higher end own stocks, and so some people that are up there in income, they feel a bit of it. But generally, most Americans, their biggest asset is at home. So because if this is indeed a recession coming up, because it is not a housing recession, it should be pretty shallow, and the consumer shouldn't feel the impact as much, because again, that slide earlier, they're sitting on a tremendous amount of home equity. That could come down a bit, but the numbers are still pretty high. So what's next? Well, this is Ned Davis Research comes out with the crowd sentiment, and the crowd is very pessimistic. So as a contrarian, this looks pretty good to me. I like that. I like when most people do not like stocks. That tells me it's probably a pretty good time to start nibbling and buying. So this is exciting to me. PEs have come down. So you look at the S&P 500, the price earnings ratios, that's price over earnings. It's below the average, which is roughly around 17. So that looks pretty good. That doesn't say that their stocks are a screaming deal, but they're certainly very well valued. And you look at the chart here, we really peaked. We were 24 times up there, rich, expensive, the price earnings ratio, and it's really come off quite a bit. So valuations are looking a lot better in equities. Also, the aggregate U.S. futures position. So this is how much are people short the market, and this is asset managers. So this isn't the individual. So a lot of managers out there are short the market. Historically, when there's large shorts like this, and this is a big number, the market tends to rally after that, because when again we have a pessimistic individual investor and we have somewhat of a pessimistic professional investor, markets tend to rally off that. Caveat, that doesn't mean immediately, but these are metrics that say that there are some things getting set for the markets to look a little bit better in the future. And as you look over time, we've seen this before, and I'm sure you've all looked at one of these charts, but the line is moving up. So if you can, avoid the red zones, getting out of the market or being concerned there, certainly your long-term wealth will appreciate that. And if you look over time, over every rolling 5-year period, about 90% of the time the market's positive. You look 15 years, it's generally positive. These are different rolling 15-year periods, but any 1-year period, there's a chance. Even in 3-year periods, there's a chance markets are down. And this is a reset, and frankly, it needed to happen. And we needed to get some of these excesses out of these markets. And then that's also why we don't time the market. When you look at this chart here, it doesn't take many days of missing the market to really hurt your long-term rate of return. Because remember, you have to do two things. You have to get out perfectly and you have to get in perfectly. Markets tend to move quickly on the front end, and if you miss some of those days, as you see here, your return over time will be dramatically decreased. You look at this also, this chart here, so we have roughly close to 30% off on the NASDAQ, roughly 20% on the S&P. So if you look in the center chart there, after 20% market decline, 1-year average, generally the market's up 22%. You look at the 3-year, 41, and about 72% on the 5-year. So markets after a downturn like that tend to move up. And so the problem is, like that earlier slide, is when do you time it? So it's really, it's time in the market versus the timing of the market. So looking forward, the war, supply chain issues, we're still going to see that. That's going to be part of the narrative. Inflation appears to be slowing as we look at commodities and various things like that. The Fed seems to be doing their job, slowing that down a bit. Now, they can't help the supply chain issues, but we can slow other areas. Interest rates seem to be in a range, so the 10-year is in, call it a 2.7 to 3.2% range, and it seems to be sitting in that zone. So any bond funds look to be pretty attractive right now, because some of these fund managers can now start buying some of these higher yielding bonds, put them in place in these portfolios. I don't anticipate much more on that side, them going up to 5 or even up to 4, just based on where everything is sitting right now. So we think it's safe to venture back into bonds. Mortgage rates, there's a disconnect. Usually they're closely tied to the 10-year bond, but there is a disconnect between those two right now. However, if that dot plot plays out, mortgage rates could be going down in 2023. But they are, any one of us who's had a mortgage over 15 years, 5% still is very, very attractive. So it's still, in my opinion, still pretty low. Recession, who knows? You could technically 2 quarters of negative GDP growth, that could be technically a recession, but we have a lot of jobs. Industrial productions look pretty good, so we'll see where that is. But again, with it not being a housing recession, it'll probably be very shallow. Slowdown in the Eurozone, so we have allocations internationally, but not a lot, we're not heavily allocated there. We think with everything going on with Ukraine and all that, and the pipelines and all that stuff being played around with, Eurozone's going to have some trouble. The consumer's not over leveraged, and they appear to be in pretty good shape. There's some cash on hand. They are spending. Now, that could all change. Jobs are good, and they're plentiful right now, but that can change. But at the current time, they look pretty good. Banks are in good shape, not over leveraged, so that was a big part of the 07, 09. Problem there, but they're not over leveraged, and so they seem to be doing all right. I think a lot of the testing and a lot of things they're making these banks do and hold as far as cash is really stymieing some of the lending and all these different areas, which is also bringing down inflation. So that's just a guess. But we showed earlier the large short interest and a negative consumer sentiment. that's generally good for markets. So we like large U.S. companies, companies with great balance sheets, strong revenue. Those are companies that maybe didn't perform. They perform, but not as well as growth stocks did over, say, the last 10 years. But they tend to just continue to grow and continue to perform. So we like those areas. And so really, when you look into the valuations, you buy stocks for the long haul. These aren't things for 1 year, 2 year. These are 5, 10 year purchases. So thank you for your time today. Feel free to like and subscribe. We love seeing your comments in this, and we'll see you next time.